Thank you to all of you for persevering and staying with us through here to the last panel of today's conference. Or as I like to look at it, this is really the kickoff to the campaign to bring you all back for Oil and Money 2016. So hopefully we'll be successful in that endeavor. But for this last panel, we did want to talk about an element of the energy world that is a brave new world in the sense of the novel, too. It's somewhat dystopian now. Gas has been a really rapidly growing fuel in the global energy mix, and LNG in particular is playing an increasing role in bringing together increasing parts of the globe into this gas mix. At the beginning of my career in energy issues in 1990, there were about 9 countries that were connected by LNG. This year, that number is above 30, and it's continuing to grow over the next several years. So we've seen a lot of greater interconnection in gas through LNG, and we've seen tremendous growth in the sales of LNG also over this time. Demand or sales of gas, and especially LNG, have increased by about 3% over the past several years on average. But the real challenge that we're facing is not only a decline in prices, especially through the linkage to oil prices, but also that, as Peter alluded to, a massive amount of new capacity will be coming into the market in the next several years. We calculate that over the next 5 years, we could see annual increments of capacity, not necessarily new supplies, but capacity that could triple the amount of demand growth that we've seen over the medium term. So this has added another pressure to the market, aside from just purely price issues, to changing pressure on the fundamental underlying dynamics between buyers and sellers, and especially a demand for new flexibility on the part of sellers. To talk about some of these issues and some of the implications of that for the rest of the industry, I'm joined today by 2 experts coming to us from some of the largest companies in this sphere. And we're going to first hear from Frederic, who's the head of market analysis at Gazprom Trading, to talk to us a little bit about how he sees the evolution of the markets and how the LNG market dynamics are developing over the short to medium term.
Thank you. Thank you for being here. It's just one slide to guide us, a few snapshots on the market and the sort of fundamental factors I've seen. This morning we heard one of the eminent speakers saying that he was pleased with LNG, and especially, I guess, the fact that it was a clubbish set of 4 companies. As you see from my title, I think that is not the case anymore, and that will not be the case anymore, because the LNG market is undergoing some very strong changes, and some of that are highlighted here. And we are facing an evolution of the market more towards a more liquid market, and probably more visible and transparent and flexible. Simple facts are coming that way. The first sheer facts that a lot of capacity is coming in the market. 150 million tons we put there, coming from about just a little bit less than 240 or 50 million tons today. That's a lot of volume coming in the next few years that will need to be absorbed one way or another by the market. Most of it, that LNG is fairly flexible, coming out of the US plants, as well as Australian ones. A lot of it remain flexible. A lot of it is uncommitted, meaning on the balance sheet of some of the project developers or some of the intermediate trading houses, especially the Asian ones. So that still needs to find the end user. And talking about the end user and the customers of the LNG market, they are probably more exposed to competition than the ones we've probably not talked enough in the rest of the 2 days. LNG through gas is exposed to competing energies on coal and even oil, as well as others. And that reflects into the buyers being smarter, I think, becoming a little bit of also traders themselves, aggregators, and not just living in a small world of gas or a small world of oil, but taking a much more proactive stance on the multi-commodity balance of their energy mix, and especially on the generation side. LNG having been very expensive in Asia over the past few years for several reasons, but some of them are difficult to explain, apart from the sheer look for increasing profits. That has destroyed some demand or displaced some demands towards coal in Asia, like we've seen in Europe. It's much less documented by the institutions, but it's a fact. It has displaced demand. I don't think that's definitive, but it is a threat. Therefore, it's important to talk about the customers and nurture demand. India and China remain critical, but then new markets, like we've seen the demand in the Middle East picking up for gas, or in other markets. Argentina was one quite active importing spot in the past 2 years. Or the LNG and compressed gas for transportation on the bunkering or on transports on ground, heavy-duty vehicles in particular. So all that needs to be nurtured, and I'm not satisfied when I hear IOCs talking just about supply, big projects, and essentially cost efficiency. I would like them to talk a little bit more about their buyers, about the customers, and how to expand the market share. So if the oil people are not doing it, the gas people will do it. And the LNG growth is forcing us to address that much more through partnerships, through expanding the market, expanding the pie to the detriment of coal, to the detriment of oil, and of alternative energies, finding the good balance with alternative energies in the new mix. And that's what we are promoting. In that, infrastructure is not so much a limitation, because it is here in terms of regasification, in terms of shipping. It's not overly complex to develop, in addition to what is existing, which is already quite great. In terms of liquefaction, we've seen, and in both liquefaction and regasification, we see a sort of lighter version of infrastructure through conversion of vessels that can accelerate the path and the growth of LNG. So all the tools are here. We just need to make sure that the disruption is not coming through indigestion of this very big supply push into the market. In that, a few comments on the nature of the market and the dynamics. Some snapshots here on the top right, but the nature of the market and dynamics are changing. The behavior of the plants in the US is going to be fundamentally different from the big plateau plants that used to drive the business. Slightly more flexibility. At the same time, the customers are, at least today, in the future we'll see, but are both uncertain and therefore not willing to contract long-term contracts. At the same time, find it a little bit more comfortable to operate on the mid-term horizon, because there is LNG around and there is a little bit more flexibility in the system. And therefore, it is a balancing tool, especially as those new gas markets, they don't have any storage, they don't have any onshore storage. So LNG is providing from Spain to India to other that don't have those big tank farms that the Japanese and the Koreans have, is providing some flexibility. And therefore, the trade has to adapt to the requirement for flexibility from the new players who don't buy base load volumes, but buy seasonal or peak volumes from now and then. So that is what we are facing as commercial people in an industry which still is quite a large capex industry. And we believe that it can adapt. It has adapted already. Critical consideration is, I believe it's the end of the traditional utility buyers signing long-term contracts point to point. They want more. They want price diversification, they want volume diversification, they want some form of flexibility, and that's very well understood and accepted. But we need to address that. But if that is combined with a low price environment, then the mental shift has to happen in the industry. Otherwise, there will be no new projects, or very limited, except big boys able to take the bet and be a little bit counter-cyclical in their decision making. But that will be limited. I just wanted to remind a lot of people, especially the commentators, that natural gas and LNG are commodity. It's not a political weapon or whatever. It is a commodity, and it applies to supply and demand concerns, and therefore a little bit of that has to be integrated in the analysis of the market. So lack of assertiveness of the gas industry, I think that has been quite sometimes shocking from the commentators, focusing or if we're an industry that expect our problems to be solved by a carbon tax, then that's a little bit, it's very weak. It is very weak. It is very passive. So what is the proactivity we need to put into just talking to the buyers, enabling more demand, and enabling a better agenda around the gas acceptability and affordability. And gas has not been very affordable, especially in Asia, where it has been priced by some operators at the equivalent of oil prices. This is ridiculous. It cannot compete on that basis. So if you want a long-term gas market, it's not just by waiting for government to sort out the problems, either through subsidies or removal of subsidies or through some taxes. It has to come as well with the industry becoming a little bit more commercial rather than just bringing new projects on stream. And then the conclusion is what I said in my introduction. I believe some of those evolutions are extremely positive for the LNG market. I remain very optimistic. It will be a little bit challenging on the short term to digest those new volumes, but they will bring market shifts which will be beneficial to the longer term view on the market and the expansion of it, and we'll be seeing a new way of, or an evolution, it's nothing, an evolution of the way LNG has been trading with slightly more transparency, slightly more price visibility, and flexibility in the system that is needed. So it is overall positive, even if the short term might look a little bit worrying.
Okay. Thank you for that. I noticed one of your comments there is small is beautiful. So I thought it would be appropriate if we had Roger as head of LNG at a boutique firm, Shell, to talk about whether or not you believe in this, and if a small company like your own can also thrive in this market.
Thanks for that. Good afternoon, everybody. I'm impressed that on a rainy afternoon in London you couldn't find something better to do than to sit and listen to us, but thank you very much for staying around. And my congratulations to the organisers as well. It's been a very interesting 2 days, and I certainly have appreciated the opportunity to close a session that was opened by my boss first thing yesterday morning. And so in the bookend, I guess, you'll get our views, and hopefully from that you'll come away with a sense of the optimism that we bring to the future of gas and the LNG business. I've been asked just to make a few minutes commentary at the beginning and then open up for question and answers. So I'll talk about 3 things, if I can. I'll talk a bit about the industry and some projects. I'd like to bring the customer into the room. I'm not used to sitting in meetings around oil for quite so long, and it's interesting how little is spoken about customers, given how comfortable you all are with it, I guess. But in gas, it's all about the customer, so we'll talk about that. And then I'd like to introduce the sustainability story as well, climate change and the role that gas has to play. So first of all, on the industry and projects. It's a relatively young industry, 50 years of LNG, 40 years in Asia. And in that time, it's been growing at 5 to 7% per annum, which means that it does double every 10 years or so. And although we're seeing that very, very strong volumetric growth coming through now, it essentially isn't too far outside trend of what we've been observing over those same 40 years. And although it does look, and we do face particular challenges at the moment to see how all those volumes are going to be absorbed, it's not unlike what we've seen when major projects have started up before. These are, by definition, relatively large, lumpy infrastructure work. So when they start up with a lot of volume. That volume has to find its way into the marketplace, and it has to be taken up by customers who need to be ready to absorb and take on board a substantial amount of gas into their system. We've come through an unusual period in the last few years. This unusual period is characterised by relatively high oil prices, a relative shortage of liquefied natural gas due to some projects in the Middle East and Africa being taken out of the system for a variety of reasons, which are well understood and many have spoken about already here. And then the very, very strong demand in North Asia post-Fukushima, where nuclear power was taken out of the system. Those variety of circumstances all combined to mean that there was a very strong pull of LNG out of the Atlantic Basin into the Asia Pacific, strong prices in the Asia Pacific, and strong demand from traditional gas buyers, stronger demand than had been anticipated by their long-term contracting behaviour. That sent a very encouraging signal for investment, for new people to get into the business and for new volumes to be taken up. And we're seeing that wave of new project startups coming through this year. And we're also seeing a combination of slower economic growth, moderating energy prices, and more gas-on-gas competition, that some of those factors which characterised the last few years are now being unwound. I think that's obvious to all of us, but if you put it together in that way, it doesn't necessarily have to look like a big step change, but rather something that's part of an ongoing trend. Shell has been a part of that business with the whole 50 years, but here in Asia, where most of the LNG is produced and consumed, for the 40 years. We've been a leader in providing innovative solutions to try and bring larger, more flexible projects in more difficult environments. Succulent Energy was talked about yesterday, a project of which we're very proud. Floating LNG for Australia as a new and innovative way of monetising otherwise hard to access gas. And we're confident that the projects that we have on the drawing board and the projects that we will be considering, that the industry will be considering over the next 10 years, will find a space in the market as well. Now to the customers. We see both very strong demand continuing in the traditional North Asian markets. They continue to absorb volumes. Everything that's produced is consumed. We see prices being determined across a broad range of factors. Long-term contracts which continue to be indexed against oil, albeit oil is at a weaker point. Gas prices determined by gas-on-gas competition in some areas, particularly in Europe. And to some extent, gas penetrating into areas which have traditionally been the province of liquid fuels. So LNG for transport, for example, where it can substitute for fuel oil or diesel as a heavy-duty transport fuel. And we've seen a particularly strong penetration of LNG into that market in China and in North America, where there's been a genuine opportunity to take up gas, in part because of the price advantages, but also because of the environmental sustainability advantages that LNG is seen to offer. We've also seen, in the same way as a large number of new exporters have entered the market, a large number of new buyers. We've seen some countries that were exporters become export importers. Indonesia and Malaysia spring to mind. We've seen countries that previously haven't taken LNG, like Thailand, open up new terminals and seeking to contract with new volumes. And we've seen some places, in particular across the Middle East, to see the need to diversify away from traditional liquid fuels, taking on increasing amount of LNG as a diverse, reliable fuel source. They're just the start. We see a greater and more in-depth penetration of LNG into new markets in Africa, in South America, and across Southeast Asia. And we see that taken up because LNG has proven itself, as it's matured as an industry, as a source of reliable energy supply that meets a sustainability agenda, that's affordable, and that once the infrastructure is in place, customers will choose to take LNG. And that's something that we're confident about, and that we invest a lot of energy, our energy, in terms of bringing energy to them. And the last one is the sustainability agenda. My boss stood up here, was quite polite about the gas versus coal discussion. I don't have to be quite so polite. I will say, frankly, every time that we bring gas into a marketplace, we can see that it displaces coal as a potential power source. And we think that improves the quality of life of the consumers. It provides them with a reliable substitute energy form, and it's a form that we believe complements renewable energy. It's the probably cheapest way of meeting our desire to address the issues around climate change. And it acts as a substantial step towards trying to address the sort of issues that are going to be taken up in Paris in the climate change discussions. And so that policy choice that can be made to bring more gas into the marketplace, in our opinion, more LNG into the marketplace, is one of the lowest cost ways of addressing the issue of how do we address climate change as a fossil fuel industry. Now, I'm happy to take questions on any of that. Thanks.
Well, yeah, thank you, Roger. Let's pick up that last point first. And Frederic, your own comment on this. I want to explore this a little bit further because we have seen that on the margin, gas can displace coal, and especially potential coal. But when we look at the generation stack on a global basis, aggregate it all up, coal has grown actually just as strong as gas has in the recent history. And in fact, the gains of both of the fuels have come at the expense of oil-based fuels and more recently nuclear. So what is it going to take to get greater penetration into the generation stack from gas especially? Can you push out more coal, not just displace future potential marginal coal, but can you actually push out coal that's in the generation stack now? And Frederic, as you mentioned, if the problem cannot be solved by a carbon tax or a carbon tax alone, what are the policy steps that need to be taken to have a greater penetration of gas in that generation stack?
I mean, talk to the customers, talk to the utilities, and work together, which means there must be visibility in terms of the costing. LNG and gas had the perception of being expensive relative to coal. Part of that needs to be solved through the carbon adjustment, one way or another. But part of that has to be solved by bringing more flexibility in the system and more price visibility over the long term. In Asia, especially after Fukushima, that perception has been blurred by very expensive prices and by an extrapolation that prices of LNG would remain and premiums in Asia would remain forever. So wrong decisions have been taken both on the producer side but also on the buyer side. So that needs to converge back, obviously facilitated as we can wish by the relative governments and organization. But it has to be built around partnership where affordability of gas is translated into the contracts, into the pricing mechanism, into visibility, and into the flexibility, because that's what the buyers are asking. As I was saying, if we moved from a sort of several 100,000 cubic meters of tank farms into new countries in Egypt or where you have a terminal, one or two tanks, or a vessel, and that's feeding the grid. Where is the balancing? Where is the provided usually by gas storage? That's LNG. Mm-hmm. And therefore, if the contracting form is not facilitating that, then buyers are legitimately concerned, or the government supporting the transition are legitimately concerned. So it goes to all that, all those fundamentals.
Okay. And then with that, with the change in the contracting form, I mean, the contract originally developed to try to apportion price versus market risks between producers and consumers to link your customers with the upstream and with the upstream development and the complexities and the difficulties of financing these very capital-intensive projects. So leaving the customers aside for a moment, or taking the customers' demands for increased flexibility, how do the oil and gas companies, the gas companies, in their upstream projects, how do they then square the circle, if you will, of having more flexible pricing contracts, and yet at the same time securing enough capital to finance projects outside of the U.S. moving forward?
Me?
Yeah.
Yeah. So it's a good question, right? And it's a good question for a variety of reasons. This has always been a challenge that the business has faced. Whenever we go into a new transformation or a different mode, whether it was the very large trains in Qatar that were oriented towards the North American market originally and then diverted away, or it's the new US export schemes coming online, or the change that has emerged with more flexible volumes and perhaps less take-or-pay commitments to, again, some of the merchant producers out of North America. All of these models need to get, at the end of the day, a finance structure behind them that allows these large investments to take place and be supported. Now, players like ourselves, portfolio players like Shell, can provide a certain amount of support, and that's been part of the customer value proposition that we've been able to bring in terms of either enabling the ramp-up of projects or aggregating customer demand such that we can put the two together. And Shell's portfolio is substantially committed against long-term contracts, which allows us to bring that coverage. It is a challenge for people coming into the industry to think, how do I, in a market which may have some perceived length over the next 5 years, how do I bring or aggregate new customer volumes to be able to start new projects? And I think that's one of the challenges that we're going to face, not that we as an industry are going to face, recognising that the output that we see today is a legacy of the investments decisions that were made 5 or 6 years ago, right? We'll see the output from the investments decisions that are made or not made this year in 2020, right? So we have to take a view essentially about where do we see that gas demand, where do we see that LNG demand in the next decade, and who is going to be able to help us identify that demand, secure it, and then, as you point out, fund it to be able to bring secure financing to what will remain relatively large infrastructure projects. Probably just on that point, though, of infrastructure projects, the critical issue, of course, is to be more flexible and to get the cost of those projects down such that they will survive in a robust and challenged oil and gas price world. And I think that's where a lot, as a major developer of LNG projects, that's where a lot of our energy goes.
I guess the business model for FID has changed as well, especially with regard to the US. US projects have been very simply pitched as cost of gas plus cost of liquefaction, and I sell the LNG, which is the fundamental criteria behind the success of it, in addition to the gas, the feed gas being relatively cheap. It's a completely new model. So Cheniere, who is, I guess, overtaking this club of 4 we have been talking about, except for potential combination on my left side. But Cheniere is the largest of all players now. And due to this fact, they have simply changed the way LNG was previously developed, and say, okay, you want LNG, you think the US is cheap, I develop it, then you market it. And you're best able to market it. I'm not second guessing the value of LNG in the market. You will do it. And that has worked perfectly well. And then the financing side has joined the story, which is quite important. But it's a completely new business model. So things can happen quite quickly.
Okay. I think we've got some time for some questions from the floor. And again, I think you've all heard this countless times, but please identify yourself and your organization.
So this is Hannah from the Leadership for Tomorrow Scholarship Program. I have a question about pricing. So you touched upon this, but my question is, how do you foresee the development in traditional LNG pricing mechanisms and formulas? So more specifically, will oil indexation stay? Will it stay, but will the slope just become lower more traditionally? Or will it just go completely? So in the case of Asia, I think that would be interesting that now, like for example, Japanese buyers, from what I understand, prefer oil indexation but with a lower slope. Or will you have more of the European example of hybrid pricing? And a little bit, I guess, similar to that is, will we be seeing an Asian hub anytime soon? So what's the chance of either Tokyo, Shanghai, or most likely Singapore being liquid and transparent enough for us to see a spot market really growing there?
Suppose we can add the St. Petersburg LNG price maybe one day? Yeah? Maybe we can do that.
Yeah, maybe. Yeah.
Well, LNG is pricing on the index, on an index by default because there is no LNG indexation that is capable of supporting with economic discovery of price the value of LNG. So it is priced on oil, and in some areas, I mean, Argentina was priced on oil plus something. So it is priced to what is felt best for the customers at the end of the day. So there is an evolution in Japan. Most of that, I think, has been driven by the perception, not that the indexation was wrong, but that U.S. gas was much cheaper for reasons so I guess it's not so much indexation that they were seeking to change, but more the price level. And that was probably not fully apprehended by the industry players at the time. In terms of emergence of an LNG index, price index, there are some. We use them from time to time, either on the physical or on the sometimes paper swaps. But at the end of the day, it has to come from where the flexible LNG is originating. So there could have been one in Qatar, but that's not so much the case. There could be, for the past few years, in fact, the value of LNG was derived by the price of the tenders out of Nigeria and Spain, more than anything else, and some form of price reporting from the agencies around that. But in the next few years, my bet is that it will be a US index that will emerge. US Gulf Coast LNG FOB, which with 60 million ton of FOB flexible LNG coming out of there within 5 years, sort of. That provide a very good base for having more transparency in the value of the LNG itself. So maybe we'll see something coming out of that. Maybe one of the Asian index will emerge, but it's not the case. And as long as it's not the case, then it has to relate. LNG is just a transient phase of gas. It's becoming gas at the end of the day. So it has to relate to the gas market and to the way the residential markets in Japan or in India are pricing that, or the generation are pricing that. So it can be indexed on anything, really, as long as it's somewhat accepted by the buyers at the end of the day. So.
To build on that, just as one follow-on question for both of you as well. As we see this, customers demand greater flexibility. Are we starting to see a consensus driving towards a new standard of the contract, or is instead the future portfolio player is not going to also be able to play from a portfolio of different sources to deliver contracted volumes under, but is it also going to be a player that can offer a wide portfolio of terms under which gas is developed? So are we going to see greater complexity in the contract structure, or is there, are you seeing a trend towards a new standard but flexible contract?
Yeah. So, do you mind? Yeah. So I don't know about there being a standard contract. We don't have one out there in the marketplace as yet. Although I think we'd probably be very happy for Shell's master contracts to necessarily set a new standard if that's where we wanted to go. But perhaps going to the point regarding flexibility and the customer. The traditional customers have got large portfolios already, and they can balance to some extent, right? They can play at the margin, either one producer against another, one trader against another, or one fuel choice or source against another. A point which we observed before was that when we were having the conversation about the oil industry in the last few days, there was a much greater degree of confidence about people being able to predict both the depletion rates and the growth in demand. The gas business is much more porous at the edges. There's much more interfuel substitution, coal, gas, renewables playing against each other, even liquid fuels to some extent. And the customers, because it's an on or off switch, when we introduce a new buyer into the marketplace, they can lift gas an absolute step change. So the flexibility that we can offer has to be able to accommodate that. It has to be able to say to a new gas buyer, you can count on us, and you can rely that you're not going to be overly exposed to spot market turbulence, and that we will be able to support you in order to grow your penetration of the gas market. For traditional buyers, we have to offer them the stable long-term contracts plus flexibility at the margin. And for a place like Europe, which is increasingly a much more liquid hub in terms of being able to place LNG, where LNG plays against pipeline gas and LNG from a variety of sources works, you have to be able to access flexible infrastructure and the evacuation routes behind the terminal to be able to take that LNG away, and it has to be priced in a way which the utilities can absorb and can take into the marketplace. Because those three different characteristics of the market are quite different, I don't think there's one standard contract that fits all. I think you need to be able to design and fit your requirements to the customer and be able to have that discussion. And so although I see that there's a greater degree of liquidity at the margin in the LNG business and in gas as a whole, I think the substantial amount of the business is going to remain relatively illiquid and determined by bilateral contracts between producers and consumers who form long-term relationships that are reliant upon each other.
Okay. I think we have time for maybe one more question.
Thank you. It's William Powell from Petroleum Economist. At this time where industry is trying to cut down its costs and bring down reduce the overhead, can you, and given also the fact that LNG loses value day by day when it's being transported, unlike other commodities which you ship, can you envisage a time when there's proper cooperation between the producers over shipping so that LNG spends as little time as possible on the water and you get the most value from your sales and the LNG price becomes more competitive again against the rival fuels? Is that something you can see happening in the next 2 or 3 years? Or
I'll have a go just to start with. So that is one area where we've seen an extraordinary amount of flexibility being introduced, right? There are many more LNG carriers out there now than there ever were before. LNG carriers of a variety of ages, technology and performance, and in fact a variety of fuel technologies that are used to drive them. I think you'd also be pleasantly surprised at the improvements in cryogenic technology in terms of both how effective they are in storage and how little boil-off there actually is nowadays in LNG. So in general, yes, I think there is already a lot of flexibility in the LNG shipping market, and as producers and traders we're able to take advantage of that, such that we rarely find ourselves in a situation where an absence of a ship pool is a problem in terms of being able to put cargoes together or producers and consumers together.
I think the fact is here. I mean, boil-off in LNG vessels was above 0.20% per day, maybe 15 years ago, something like that, 20 years ago. We are now going to less than 0.1%. Probably even in the next generation of vessels, much lower. So there have been some genuine technical advantages on the LNG shipping and containment system, which also can operate in different conditions, sea conditions or even Arctic conditions for the Yamal projects, as well as trading conditions with part loading or part discharge and sloshing issues being much more understood. So that's where technology has progressed quite a lot and is effectively providing very good support to the industry.
Okay. And with that, I think we need to bring this session to a close, unfortunately. But would you please join me in thanking our 2 panelists with a round of applause.
Good.
Thank you so much. Great job, guys.